Good morning all, hope everyone's well. Usually when doing these presentations live, this is the part where we say it's great seeing everyone in person. But unfortunately now, the way of work these days, we're having to restrict our voiceover, but I do hope it works just as well, and you are able to take the information and knowledge you're after on the VGTR. We've been asked by our friends at Ukie to do a quick talk on the UK tax relief for the game sector and how the accountant's role can help. We've tried to condense it down into 30 minutes, but I do appreciate it's a lot to take in that short period of time. So we will be around over the networking lunch to take any questions. So please do hold on to them. Feel free to shout when we get around to doing that. So moving on into the presentation itself, we've tried to categorize this into 4 areas. That being what the tax credit is, why claim the games tax credit, which tend to go hand in hand, and that would be the section that I'd be looking after. And then I'll pass on to my colleague Terry Bourne, who will talk you through who can claim the relief, and more importantly, I'm sure as a lot of people would like to be made aware of, is how the claim itself is made. So without further ado, talking through what the video games tax relief is. Initially, the UK government had announced creative industry tax credits through the film, and then later the high-end television and animation tax credits. Those worked so well in terms of enhancing the industry and bringing work to the UK in those particular sectors that the games tax credit was announced in April 2014. What this enables is eligible companies to claim tax relief on their qualifying production expenditure, which we'll talk through later, but it was effectively brought out to try and incentivize video game production in the UK. And ever since it's been released since April 2014, it's gone on leaps and bounds, and has enhanced the industry as a whole, as I'm sure you'll find through the course of today. Now, why would the UK, provide those incentives when they've already had 3 other creative industries and without there being anything in it from them? And what we find is obviously there is something in from them. In terms of what's contributed, for every £1 that's spent by the UK government, they would estimate a return to the UK economy of £12.49. Hence why they're bringing out these incentives, given how much it adds back, and whether that's in the form of keeping individuals busy through subcontracted work, or whether it's production houses, or whether it's hotels. It's contributing to the UK economy as a whole in almost all areas, and that's the reason why these incentives are brought out by HMRC. Obviously, they would be bringing them out if it was beneficial to them. In terms of how much it's worth, it's a rebate of 25% on qualifying spend. We'll talk you through what the qualifying spend is on through the next slide. But one of the key incentives of what the video games tax credit relief brings to the UK is the fact that it's payable to the production company in cash. And the nice thing about that is the fact that there are probably bigger incentives worldwide, but they tend to be used against profits that are made by the company. And effectively, if you're not profit making, then it just means that those video games tax reliefs are never used. The joys of this one is that the fact that it is payable in cash, in a fairly quick turnaround time too, is what incentivizes it that much more. There's no cap, so in terms of the number of claims you can make, or in terms of the amounts you can claim on, so whether it's a small app that you've developed for the phones, or a big production, one of these big video games that are released on platforms such as PlayStation, it's claimable for all. And in terms of there's no sort of set sunset date. So for example, as long as you're enhancing the game, if you're spending, you can be claiming video tax relief on those amounts. One of the nice things about this one, and what you do find, and this is especially important to know for video game developers, is the fact that it is bankable collateral for borrowing. So you can go to a bank or a third-party financier, and they can secure lending against the video games tax relief. Why this works so well is the fact that, in terms of how the video games tax relief works, is it's payable once you've incurred the spend. So obviously by that point, you would have had to absorb those costs. Those costs you would need to have covered through some sort of finance. And that's the nice thing about being able to take it to a bank or a third-party financier to get the borrowing, is the fact that you have that cash up front. From their point of view, it's fairly safe money, given HMRC to date have paid out. There's no issues with them not being able to pay out creative industry tax credits. And the nice thing is also it means that sometimes you're seeking that much finance less. So what you find is video games tax relief have made their way into finance plans. So let's just say for optimum point of view, the maximum tax rate you would get is effectively 20% of the budget, provided all spend was core. you would then only go looking for 80% of that finance. And that works so great because what you tend to find is asking someone for 100% of the budget is a lot more difficult to do than asking for someone for 80% of the budget. And it also means that developers can have a bigger share in the waterfall. But we can talk about that. You know, that's probably a question to have with your accountants and lawyers in that regard. But the nice thing to know is that the fact that it is collateral and you can effectively borrow against it. So in terms of qualifying spend, what is qualifying spend? And that calculation is effectively based on the lower of all the UK EEA expenditure you incur versus 80% of the worldwide expenditure. So effectively you take two values, you've got a production, you take 80% of the worldwide expenditure, and you take all the UK core expenditure that you've incurred in the UK, and you compare whichever value of them is the lower amount. Whatever the lower is the one that would get the tax credit. Two questions that arise from this is, what is deemed core spend and what is deemed UK EEA spend? So we'll discuss that just through the next slides. In terms of core expenditure, we've tried to break down the categories of production into 6 key categories. Sorry, as accountants, you're probably more well versed than we are in terms of the stages of production, but we've tried to condense it into these 6, where you have the development of the concept, which is the initial stages before effectively the game has been greenlit, the pre-production and design stage, which effectively is after the game has been greenlit. You've got the production stage, the post-production and testing, and then afterwards, once production's been completed, you have the distribution and obviously the commercial exploitation too. In terms of what would be deemed as core expenditure, it needs to be wholly and necessary incurred for the development and production after the series, after the game has been greenlit, and hence in that regard, development of the concept would not be included as core spend, and similarly, nor would distribution and commercial exploitation. The only stages that would be deemed as core spend would be the pre-production and design, production, post-production, and the testing. The reason being is distribution, commercial exploitation, and development are not deemed as wholly and necessarily required for the production of the game itself. Other areas to note that would be excluded are finance costs. So anything related to finance, whether it's financing interest on a loan you may have, an arrangement fee on a loan, or it's essentially legal fees that you incur on finance to maybe draw up agreements with financiers. All of those costs would be deemed as excluded and non-core because they relate to the finance side of things. Post-completion costs not related to enhancing of the game, so the likes of the debugging, or if you had small tweaks that you're making to the game post-completion, those won't qualify. In terms of those costs that relate to enhancing the game, my colleague Terry Bourne would be going through that later through this presentation with yourselves. Capital expenditure, so what you find is big developers may develop a sort of software platform, or to essentially make numerous games from. That would not qualify for video games tax relief, and the spend on that would have to be capitalized. You would get what's called capital allowances on that value, which won't be to the same benefits of a VGTR, but it's a separate tax incentive on them. I mean, it's mainly big developers that look after that. But what you do find is that although you may have enhanced a software, if you're charging, for example, an SPV to provide that software to them, then that would qualify. So it's more the actual capital spend on producing that platform or video game, that you've incurred that wouldn't qualify. Licensing that software obviously would qualify. So that's something that we can discuss if you had any queries regarding that with the accountancy. Entertainment and marketing, obviously that's an area that isn't wholly necessary. Whilst it does, it's great to promote the game. It isn't seen in HMRC's eyes as being essential spend. So anything marketing or entertaining related publicity also falls into that bracket, would be excluded. And whilst it's rare to find any spend you incurred prior to the release existence, I must admit I'm yet to see any expenditure on video games prior to April 2014 that anyone is still looking to try and claim to date. So it's very rare these days, but that's just something to note, that anything before the release came into existence that you had incurred would obviously not qualify. So that covers the core spend. The next thing to look at is what is UK and EEA spend. So how do we determine whether something is spent in UK EEA? The video games tax relief is based on the used and consumed rule. So essentially what you need to look at is where the service was consumed. So was it on UK soil, or was it on the EEA soil, or was it elsewhere? As far as we're aware, post-Brexit, these rules still apply. So hopefully, we've had no reason not to believe that it go back to just being UK. But at the moment, the incentive is very much UK EEA and still follows the old rules. Hopefully that remains. But in terms of the used to consume rule, it's based on, it's a question of fact in each case to determine where a service was undertaken. What you may find is in these scenarios you may need to apportion between locations, and that's very essential to do. For example, if you had a video programmer who spent half his time in the UK and the rest of the time, say in the States or Canada, you would need to apportion their time, their fees 50-50 in that regard, or whatever ratio that would, ends up being. So just to put this in a scenario terms, as I feel like scenarios always work the best. So we've got a video artist who works on a game, and effectively, sorry, a voiceover artist who works on a game. This was added to the game in the country of the developer. So essentially, the artist has recorded over the character in the game, and it's added to the game in wherever the developer was based. So in our two scenarios, we've got one where we have the artist is based in the UK and the developer is in the USA. So the artist would record in the UK, provide his recording to the developers in the USA, who then would add that into the game in the USA. In the second scenario, we have a developer in the UK who would record in the UK and provide his work to the so the developer in the UK, the artist is in the USA, who would record his work in the US and then provide that to the developer in the UK, who would add that onto the video game in the UK. In the scenario where the artist was in the UK, that would be deemed as not used and consumed in the UK, because where the service is consumed is by the service is effectively consumed by the developer who is based in the USA. That's where it's made its way onto the game, and hence in that scenario that wouldn't qualify. Similarly, for example, the developer who was in the UK who provided, so if the artist was in the USA, provided his work to the developer in the UK, that does qualify, given it's used and consumed in the UK in that scenario. The service is being consumed obviously by the developers in both scenarios, so it's mainly based on where they are as opposed to where the original recording took place. So to put this into calculation terms, we've got a scenario here where we've got a production that's the income is fully financed by a financier of 4 million. All of the spend is in the UK, or UK EEA, and it's all core. So in our scenario, going back to our original calculation that we had discussed, it's basically we need to work out our qualifying spend, which we take as the UK EEA core expenditure, which is the 4 million. We take 80% of the total core spend worldwide, which is 3.2 million. The lower of these numbers is obviously the 3.2. Multiply that by the effective rate of 25%, and we end up with a tax credit of 800k in this scenario. In the second scenario, we've got the same production, except for this. On this occasion, we've spent 1 million of the overall budget in a third-party country. Let's just say, for argument's sake, it's the US. So in our scenario, what's our total UK EEA core spend? It's 3 million. What's our 80% of our worldwide core spend? It's 3.2. In this scenario now, it's the UK EEA number that's lower, the 3 million that's lower. So that makes its way to the qualifying spend. We take 25% of that, and on this production now, although the overall budgets for both were 4 million, just determining on where our UK spend was, and sorry, UK EEA spend was on, we've ended up with a tax credit of 750k. This next table would show us that effectively in sort of percentage terms, showing us how much we'd spend in the UK EEA, and that will show us, on the assumption that it's all core spend, what tax credit we end up with. So as you can see, anywhere between 80 and 100, it doesn't impact the overall tax credit, so we'll always be at 20%, regardless of whether we spend anywhere between 80 to 100. But as and when you spend less than 80% in the UK EEA, you can see the effective rate of tax credit diminishing, the minimum being 25%, so at the very least, the tax credit would represent 6.25%. Just to very quickly talk through some potential pitfalls. One of the things to note is for VGTR claims, you are entitled to subcontract work up to a cap of £1 million. So what we've got to to make sure we do is when we do subcontract work, it doesn't exceed the 1 million mark. Now, not every cost that you incur is going to be deemed as subcontracting, any payments that you make to third party, and that's why it's always good to check maybe with your accountants or lawyers whether the spend that you're incurring and the nature of it, forms part of whether it is included as part of that subcontracting work. That's always good to check in with them on. Something else is part of the reason why the creative industry tax credits work so well for HMRC is they use them as collateral against any VAT or PAYE issues that a company may have. So, for example, if you are under VAT investigation, or if you are under, if you feel like you haven't paid all your PAYE and nick on your employees, they'll be very quick to try and hold off on that tax credit up until you've settled those matters. And that's why it's very important to make sure you are on top of all your VAT and your PAYE affairs. Just be on the basis that they will hold back creative industry tax credit, video games tax credit included, until those matters aren't settled. One of the other things that's very important to stay on top of is, as we discussed earlier, is apportionment. What we find is, although contractually sometimes you may find that you may have an agreement with your developer to spend X amount of time in one country and X amount of time in another, in reality, that may not always follow suit, and that's why it's always important to make sure that you can track the apportionment of time, so that when you do essentially make the claim to HMRC, you've got the evidence to back that up. Whether it's keeping on top of flights that you may have taken, or whether it's just time spent in other forms. It's always good whilst you're on production. I mean, as you'll always expect, it's very difficult to remember back. It's more difficult to remember back time that was spent in certain countries. It's easier to do it as you go along. So one thing we do try and get video game developers to do is to make sure, if you are making VGTR claims, just make sure you know who's where, when, and apportion time accordingly. So it just makes matters that much easier when you come around to submitting claims. One of the other things that's very important is ensuring you recognise it as a separate trade. Now, in most scenarios, what you find is the ideal structure is always to set up a separate SPV, purely because of the benefits it gives you regarding straddling dates, and my colleague Terry will be discussing that later. But on the chance that you haven't set up a separate SPV and you're making multiple games through a particular company, it's very key to be able to isolate the income and cost that you have in relation to that game. Partly because the nature of how the tax credit claim is made is it's a function of your company accounts and tax returns, and on those returns you need to be able to isolate every trade, and every game that you make is almost a separate trade. So for each one you have to show what income you've incurred and what costs have been incurred. And the key difficulty we find with these is a lot of the times you might have similar employees working across a range of games, and in terms of their costs that you've booked into your system, it's all under the same code, and what you need to be able to do is demonstrate how you've apportioned his time across, or his or her time across those games. And that's why it's very important to make sure when you are recognising entries within a separate trade, whether it means creating separate codes for each game or holding them under different cost reports, either or, but it's just important to make sure that's in the back of the mind. Year-end reporting, always very key as well, is that you are entitled to make as many claims as you want for VGTR purposes, but you do have to close off accounts and tax returns on those dates. And what's always key to keep at the back of your mind is when is your year, whether you have group reporting deadlines, or whether you are essentially capable of closing year-end reporting dates. And one of the key things why SPVs work so well is the fact that you can actually straddle periods. So if you felt your game was complete, there's nothing stopping you from closing your books to that particular date. But when you have more than one trade on, it's more difficult to close all the trades to a particular date, and that's why sometimes year-end reporting is something that you do need to factor in. It's not as easy as a case of the games made when you've got multiple trades in a company, to close the books. Another thing that's slight, some may say it's not that big a pitfall, but the fact that you are always just got to keep in the back of your mind. I know there is that, the way we've just shown the calculation to work, the 25% does almost lead you to believe that it is a 25% incentive, when, as we've just seen, the effective rate is never more than 20. So you are limited to 20%, and there are probably a handful of video games released worldwide elsewhere in other countries that might be more than the 20% mark. But I think in terms of the hub that you have in the UK, it's not so much of a sort of pitfall to have that capped at 20% of the team. What's also very important to know is the fact that, as we've just seen earlier, is you can go up to 20% elsewhere without it impacting your tax credit in terms of outside the UK EEA, as this previous spreadsheet had shown us here. If you look at the UK EEA core expenditure, anywhere between 80 to 100%, you don't impact your tax credit overall. So it's just handy to know that you may want to take that 20% elsewhere. If you thought it was cheaper to do some, and that's where we really find is it might be cheaper to do it in the Far East or Asia, and then we find that with a lot of the games, sometimes just to make to help with cash flow, whether it be it that or be it for some other reason, it's always handy to know that you are entitled to do that, and there's no direct impact on the VGTR side of things. So that's just a quick overview of potential pitfalls. I'm sure there's some that we've missed, and we can certainly look into doing them, talking them through if you have any specific questions on that. But, moving on to now who can claim, I'll pass you on to my colleague Terry Bourne, who would take it on.